talking about investments today, something I love to talk about. I manage $130 million, by the way, every day. This recent sell-off cost me about $3 million. Just to give you an idea. Some of my largest holdings are companies like Amazon and Comcast and AT&T and Verizon and Dominion Power and others. And I'll be talking about how you can invest wisely, and I'll give you a really good background on how to invest. This comes from a course I teach at the University of Richmond and also at Randolph-Macon College. So this is one section that I teach of a 6-hour course, just to give you an idea of what you're going to be getting. And this is the investment section, because I was told to teach you guys about investments. So this is going to be fun. It's fun for me. So when we're talking about investing, there are certain things that you should consider before you do invest, like where you are in life, how long before you retire, or something like that. And in your case, you know, when do I need to get started investing, etc. So some investment categories, I'll take you through those. So we'll talk about cash, bonds, stocks, mutual funds, exchange-traded funds, unit investment trusts, individually managed accounts, annuities, which I don't like, but they're in here. Types of investment risk management strategies. So we're going to hit all of these topics very quickly. This is going to be like drinking from a fire hose for most of them. So pay attention. Now the slides are going to be available to you, and by the way, the slide deck that I provided here at the school is much more detailed than what you're going to hear today. Because if I went through this, this would take me an hour and a half to really get through this one section. So we're going to cover it as quickly as we can, touching on what I consider to be the most important aspects of investing. So the first thing you need to think about when you think about investing is, when you're looking at things, you have to think about what are your objectives, what's your time horizon, what your current investments look like if you have some, okay, and then also your tax situation. Now I work, by the way, with a lot of retired doctors. I also work with a lot of retired professors from VCU, actually, quite a few actually, which is surprising. And your tax situation could vary depending on how you're investing. So you need to be aware of this as well. So consider why you're investing. Do you want growth in your principal? Is that your primary objective? I would argue for anyone under the age of 40, that's 45, that's probably your objective, growth. Not so much the income side of things. And what do you need to accomplish as you go forward? So your time horizon is important. If you're looking at a 20 or 30-year time horizon before you retire, that's a long time horizon, you can be aggressive. If, on the other hand, you are investing for a specific objective, like a down payment for a house or something like that, your time horizon is going to be shorter. And so you may want to invest differently given that shorter time horizon. A longer time horizon does allow you to add more risk and potentially provide you a greater rate of return over time. The handouts that I gave out, if you'll notice, that's the history of the S&P 500. What has it done historically? When you're looking at long periods of time, what has it done? Yes. It's gone up, correct. In fact, I don't know if the average is in there, the average is somewhere north of 8% on average over a long period of time. So that's growth for you. And that's just the S&P, that's just the large cap stocks, okay? There are other stocks out there in other investment categories that we'll talk about that have higher potential for return also, greater potential for loss. You know, if you take on more risk, it's up and it's down. So you have to take the good with the bad when you're thinking about things. So as you get older or you're getting closer to your retirement goals, you know, that's a shorter time horizon. Or if you've got a goal of, 5 years to have the down payment for the house ready, that's a shorter time horizon. So you want to invest a little differently for that. You can't count on good markets when you've got a short time horizon. You invest differently then. Different investment categories that we'll be talking about. So what do your current investments look like? So for instance, do you know the yield on your current investments? Do you know what the growth history has been on your current investments? Do you know the Sharpe ratio, the alpha, the beta, all these things. These are statistical terms I'm referring to help you evaluate your current portfolio. Something if you met with a financial advisor or if you went online, you might be able to find the tools that would help you do this. They're on sites like Fidelity and Schwab and others that can help you with this process. What's your tax situation? Are you making taxable investments? I would argue if one of your goals is saving for the down payment on a house, you're going to have to invest in taxable investments to get there. Because you're not going to put that in a Roth or an IRA account because you have limitations on your ability to get to that money. Okay, if you're prior to 59.5, by the way, any kind of qualified account, be it a Roth, a 401k, or deferred annuity, anything of that nature, you take money out of that baby, it's a 10% penalty, in addition to you having to pay tax on it. So you don't want to take money out too soon. So there are more investments out there to choose from today than ever before. I mean, it can be very confusing. But I'm going to simplify it for you because in truth, all investments fall into two categories. You either loan your money out, and many of you probably have this type of investment right now. It's probably the first one you ever had. Or you purchase and own an asset. This could be a business. This could be real estate. This could be stock. When I talk about loaning your money, what am I talking about? What's your first investment, most of it? Checking or that paid interest or a savings account. Savings accounts are what most people invest in first and think of as an investment. And all you're doing there is loaning your money to the bank for some return in interest. That's what you're hoping to get, is a return to you of interest on your account. That's a loan. Now, we can take this and we can blow it up into different things. So these are examples of some of those loan accounts that are also super safe. Okay, very, very safe. Savings accounts, cash categories, so that you would also be talking about money market accounts, CDs, things of that nature. So these are safe investments that pay you do diddly squat. Very, very low returns usually, but they're safe. So, you know, 1% is better than losing money, right? And that's one way to think about it. Stable value fund inside of a 401k would be an example of a super safe investment. Might pay you 2%, but there's no downside risk on it. Okay, now we're going to get into bonds now too. Bonds are also loaning money. So these are IOUs. One of the reasons that the stock market is down so much is because Treasury bills, which are bonds, have seen their interest rates go up pretty dramatically over the last week or so. Now, why would that happen? Why do you think that's happening? Isn't the economy pretty good? Isn't it like going gangbusters? Well, guess what? That's why the interest rates are going up. There's a direct correspondence. The better the economy, the more likely the interest rates are going to go up. And that's what's happening right now. Also, the Fed signaled last week on Wednesday, Powell said, yeah, we got to get back to sort of a normal kind of a rate out there, and we're a long ways from that. A neutral rate, he called it. Well, we're a long ways from a neutral rate. Well, that means that interest rates have got to go up a lot more, and it was actually a little bit of a surprise to the market, not so much to me, that interest rates needed to go up more. We've been expecting interest rates to go up even more rapidly than they have been, and we don't think the Fed's going to back off. Now, the problem with bonds, the advantage of a bond is if you buy a bond the day it's issued, you can expect a fixed income over a certain time period as well as the return of your principal. There's a lot of bond categories. Treasury bonds, government bonds, they're taxed as ordinary income to you. If you get into corporate bonds, they pay a little bit higher interest, taxed as ordinary income to you. Now, if you buy a municipal bond issued by, say, VCU or the state of Virginia or some municipality, those interests are tax-free. So if you want to buy something that's tax-free, look to muni bonds. There's also muni bond funds and muni bond ETFs. The disadvantage here is that the corporation or government that issues the bond may not be able to pay you the interest or return your principal. Why would that happen? Go out of business. Or they default. You know, a lot of municipalities around the country lately have had trouble because of their pensions, being able to maintain their pensions, and they've actually gone out of business. Now, you don't want to buy what we call high-risk bonds, okay, directly. Now, there's nothing wrong with high-risk bonds necessarily if you buy them in some sort of fund or ETF. Why? What do they pay you? What is a typical junk bond? I'm talking about junk bonds here. What's the interest rate on those currently? What's the market giving? Anybody know? About 6%. Well, that's a whole lot better than the 1% you can get, or even 0.1% you can get in a savings account. But you're taking on more risk because the credit rating of those companies is much higher. I mean, much lower, rather. So you've got a low credit rating, and usually these are longer term bonds too, so longer duration bonds to get the higher interest rates. So when you've got bonds like that, you've got increased risk but higher yield. Conversely, government bonds or really highly rated corporate bonds, high ratings, maybe a little bit lower duration, 1, 2, 3 year, you're not going to get as high an interest rate. Those bonds are paying 2 and 3% right now, but they're safer. Okay? And usually when we buy individual bonds, we look to buy corporate grades as opposed to the higher rate grades. Simply because when we're doing bond ladders, we buy and hold these bonds for longer periods of time, which is a great strategy when you're retired. I don't know if you guys need to worry about that. So I'm going to try and make sure I keep this to what you guys, what's important to you. Also, the bond market is something that's issued in a secondary basis. So the bonds, by the way, dwarf the stock market. I don't know if you guys know this. The bond market is like 7 or 8 times the size of the stock market. It's huge in comparison, worldwide. Much, much bigger. And it's sold, bonds are bought and sold and traded in a different market, but it is a secondary market similar to the stock market, okay? We are buying and trading bonds all the time, and we may be buying bonds at par, in which case we get the full interest rate, in this particular case 6%, and when the bond matures we get $1,000 back, in that example. Now if we bought it at a discount, we get $1,000 back when it matures. That means our yield is actually 7.5%. If we had to pay a premium to get the bond, say $1,200, we're still only going to get $1,000 back, same interest, but we're ending up with a lower yield. So this is how you calculate yield on individual bonds. Now, bonds versus bond funds. These are sort of different categories, but bond funds are all secondary market. If you buy an individual bond and hold it for duration, as I mentioned, you get the $1,000 back, you really don't have a lot of exposure to interest rate risk. You calculate your yield up front, you know what you're going to get, you know what you pay for your bond, you know what you get on the back end. If you're investing in a bond fund, however, that's not the case. For every 1% rise in interest rates, bond values drop 8%, and that would apply to bond funds. So right now, bond funds in a 401k or other, not a great place to be, because they are getting hammered with these higher interest rates. Interest rates go up 1%, 8% drop in the valuation. In fact, year to date, the intermediate bond index is off almost 4%, and that includes the yield of 3%. So how much are they off? Almost 8% when you think about it, as interest rates go up. So you have to be aware of that when you're dealing with bonds. Now, owning an investment, this is the stock market, again, a lot of times. But this is where you are looking for appreciation over time. And for most of you, anybody, again, I say get back, all right, let me just sort of back up. So I have this philosophy about where you should be investing early on. I'll give you this real quick. So if your tax bracket is relatively low, it doesn't have so much to do about your age. A lot of this has to do with your tax bracket. If your tax bracket is, say, under 20%, maybe 15%, something like that, invest in the Roth if you have that option. Go Roth. In other words, don't take the tax deduction. Put the money in to the Roth so that later on it's tax-free to you. And many companies now, including VCU, they have Roth options for 401k investments. So I would go Roth early. As your income rises, once you get into higher tax brackets, then switch to a regular 401k, because then the tax deduction is important to you. You'd rather have that tax deduction and let those dollars work for you, because later on, you'll be in a lower tax bracket when you're taking the money out. So invest early in the Roth when the taxes are lower. Switch over to being in the 401ks where you're getting the tax deduction, or IRAs or SEP IRAs or what have you, whatever the vehicle is, where you can get that tax deduction. So when you're investing in stocks and mutual funds, you're looking for growth. And owning an investment is based solely on price, and you're looking for capital appreciation. You may get some dividends. By the way, what's the yield on the S&P 500? Anybody know? There is a yield to the S&P 500. It's not just all growth. Why would you guys? I don't have any hands going up. 2%. So if you own the S&P 500 index right now, which is, by the way, what I put my own daughter in, IVV, which is an S&P 500 index. There's others out there. That happens to be Fidelity's, and it's an ETF, exchange traded fund. I'll talk about those in a few minutes. You're going to get 2% cash back to you in dividends each year, regardless of what the market does. So you already know you're going to get 2%. Market goes down 4, your net down 2. You follow? Market goes up 6, your net up 8 with the S&P. All right, so you're hoping to get some dividends too. And also, equities provide you with the best inflation hedge. Historically, inflation is a killer. Does anybody know what a good definition for inflation is? Things are going to cost more in the future. Stuff costs more. It goes up in cost, without a doubt. Anybody ever bought the little book or seen those little cards that say what stuff costs in a certain year? Bought that for your mom or dad? My daughter did this to me. And I looked at it, and a new car, when I was younger, was like $2,000. For a brand new car. Top model, you know? Can you buy a car for $2,000 today? Brand new? I don't think so. That's inflation. A new house, average price, when I was younger, $30,000. Average price, okay? Median price. Median price today is $200, okay? That's inflation. It is not going away. Historically, long-term average is about 3%. The last 20 years it's been about 2%, but it's inching up right now. By the way, that's why interest rates are going up. Because inflation, the risk of inflation is going up. How am I doing on time? So owning equities may involve more risk, but they have the potential to provide you with much higher long-term returns. So you get capital appreciation when you own a stock. You get dividends, potentially, if it's a dividend stock. By the way, Amazon doesn't pay dividend. Neither does Google. They are growth stocks. Okay? You also may get an inflation hedge. Okay? Historically, stock has been the best defense against inflation. And that little graph that you've got in front of you illustrates that. That's why. Because over time, it goes up a lot more than inflation does. Disadvantage of owning stock, there's no assurance here, no FDIC, no guarantees, no promises, unlike bonds, to repay your principal. If the stock bombs on you, company goes out of business, you lose it all. Okay? That's the downside risk. That's why you want to spread your risk. You know, you don't want to go out there and buy penny stocks, okay? Anybody know what a penny stock is? Less than $5 a share. Which are a lot of the marijuana stocks right now, penny stocks. Just in case you're wondering. Not Canopy though, that's a Canadian company. They're up around $50 a share. So a little more stable. I own that one. All right. And unless you happen to be involved in an IPO, does anybody know what an IPO is? Initial public offering. Okay? And a lot of times this occurs if you happen to work for a company that then goes public. Anybody ever had that experience? I have. The company went public in '06 that I worked for. I got a bunch of IPO shares. And then I retired and started doing this. That's a true story. Not long after. Because I can afford to change what I was doing in terms of my life at that point. But normally you're buying from secondary markets, the U.S. Stock Exchange, New York Stock Exchange, NASDAQ, etc. They all have their different rules for listing and so forth. But basically what determines stock prices is supply and demand. The markets are extremely efficient. Okay? They finally sold off because all of a sudden the market realized, oh my gosh, interest rates are going up. Well, we knew that. So we backed off a little bit. They tend to be very efficient. I have a feeling that in a week or two, as earnings reports start to come in, the stock market's going to go back up. The bull market's not over with yet. It will end, okay? But it's a little premature to think it's ending right now. We got a 5%, pullback in the markets. That's not even a correction, by the way. 10% is a correction. We had that in February. Now, if it keeps going down and we get a 10% correction now, that's a little different. That's 2 corrections in 1 year. That's a little spooky to me. And we start wondering, okay, what's underlying? We need to look at the data. But I doubt it's going to do that right now. So there are a lot of different indexes out there. I mentioned the S&P. That's an index, but it's also all the top 500 companies out there in terms of market cap. That's what makes up the S&P 500. Great index. It's one of the indexes I follow closely and benchmark to in terms of performance. And that's what you all have out there in front of you is that S&P chart and the history and sort of plotting events throughout history that have impacted it. Because it does react to things that occur out there in the marketplace. Sometimes you can work with a professional manager to help you sort of manage through this, or you can go online to get help from different engines. There's lots of engines out there now that can help you with your investing process and picking sort of the right mix for you. I would argue that most of you should be 80–90% equity right now. And how you build that mix out is up to you, when I'm talking in particular with the 401k, which is definitely a long-term investment, or an IRA. Any kind of qualified investment is long-term, but you can't get to the money, okay? Outside of that, you might invest differently. But I would still, if it's more of a long-term play for you, you're not going to touch the money for 5+ years, I would still be pretty heavy equity right now. All right. Stock categories. There's 2 basic types of stocks issued, common stock and preferred stock. I use preferred stock as a bond. It's a bond surrogate, okay? Preferred stocks on average pay about 5.5–6%. Very similar to high yield bond rates, right? But maybe without as much risk. Because a lot of the companies that issue preferred stocks tend to be banks, tend to be highly rated. So you can get highly rated companies and get a 6% return without really worrying a whole lot about it. This becomes a lot more important, by the way, when you're dealing with a shorter term investment, when you like to get 5.5–6%, a preferred stock ETF, relatively safe, not a lot of downside, some downside, but not a lot. You're going to see your overall return be more in that 4 to 5% range, even with rising interest rates. Okay, so it might be a good place to park some money that you're trying to grow on a short-term basis. I use it a lot for retirees because they need yield in their portfolio because they're taking income out. See, when you retire, the whole idea, by the way, of investing over time is to build up enough assets so that when you're ready to retire, your income is paid to you from your investments. Okay, and that's when I say yield on investment, I'm talking about the income flow from your investment portfolio. And if you build it up enough and you're getting a 5%, 4 or 5% yield, all of a sudden, $1 million, you're looking at $40,000, $50,000 a year. $2 million, you're looking at $100,000 a year. Okay, so that should be some goals that you should be setting for yourself long term. Because then you don't have to worry too much about the market, actually. You can be in the market, but if your overall yield is 4 or 5%, you know the income flows there, you don't have to worry about running out of money in a down market. Because another thing, I didn't give you the bulls and the bears, but if you look at the history of the market, look at the bulls and the bears, which is when we have up markets versus down markets. The bears are teeny tiny, 1.5 years at most. Most of the time you're looking at 6 months, 3 to 6 months for a bear market. Very short time periods. Bull markets tend to run for 10 years plus, sometimes 20 years. Okay, so it's a very different lookout. So you need to be in that investment market long term, and that's where you're going to be in common stocks. Okay? The S&P 500 is all common stock. That's what you're buying. It's a different environment for you. Now, I am going to mention the difference between growth stocks and income stocks. So if you decide you want to get and buy some individual stocks in your portfolio, which kind do you want to buy? Yeah, see, everybody's quiet out there. I would argue buy some that are going to give you, especially depending on, it's all about your goal. So one of the nice things about income stocks, these are stodgy stocks, I call them. Usually defensive in nature. Talking about Dominion Power. Talking about Altria or Philip Morris. Why are they defensive stocks? People have to have energy. People also have to have their cigarettes, I'm afraid. They don't stop buying them just because there's a recession. Healthcare stocks are considered defensive. Why? Even in a recession, people need their health care. So those are all considered defensive stocks, and most of them tend to have pretty good dividend streams. Okay, these are stocks that have real established track records on P&Ls. They know their business model, and actually they report out and they try to make the dividend as big as possible. Anybody know what most dividend stocks pay today? It's around 4% on average. So anything 3% and above on a dividend yield, I consider a dividend stock. AT&T, Verizon, dividend stocks. They're both over 5%. Altria and Philip Morris, both over 5%. Dominion, right around 4%. Okay, so these are all companies that focus on being able to pay that dividend. Okay, that's sort of the mindset of the company. They want to grow too, and they will. They just don't grow rapidly. On the other side of the house, growth stocks. These are companies that say we're going to invest in ourselves and grow the company as fast as possible. Most of your small cap stocks fall into this category. Biotech stocks tend to fall into this category. They're growth oriented. Everything's about growing the company. Amazon, Google, grow the companies. Apple, still a growth company, but they're starting to mature. They're starting to pay a dividend now. They're sort of in the middle of the road. I still consider them a growth company, a growth stock, but they're changing. Microsoft also paying a dividend. They're changing. But they are growth-oriented. Adobe, Salesforce, these are all companies that have been up over 100% over the past year, by the way. You can hit home runs with individual stocks. Yes, Amazon dropped 6% the other day. They're up 106% over the past year. So that's nothing. It's a drop in the bucket, really. So you can make some money on individual stocks if you decide you want to play that game. Just be careful. I would focus more on the large caps if you're going to do this. But if you happen to know a lot about an individual small cap company or a biotech company, it could be a good bet for you. Okay? Because those are the areas where you're going to see the most growth. I mentioned small caps. These are companies with $2 billion or less in terms of valuation. Large caps are $10 billion or greater. Mid caps would be the ones in between, 2 to 10. Okay? And each of these are different risk categories. As you go up, you're seeing different risks. On the other side of small caps, and the risk would be emerging markets. Maybe even international development, although I'd probably put international development to the right of this, maybe a little below mid caps, in terms of the risk profile. The bulls and the bears. I sort of mentioned this already. Historically, bull markets are of longer duration and result in a buy and hold strategy. Warren Buffett is a great example of someone who's buy and hold. Value proposition. Try to buy it, he just holds on to stuff. Does anybody know if Berkshire Hathaway stock, original issue, 1 share is worth today? 1 share. $350,000. By the way, I think that's what Amazon will be one day. Unless they do a lot of splitting. Which they're not showing that they will. They were at 2,000 just recently a share. All right. Employee stock options. If you have the opportunity to get employee stock options, take them. Because normally you're able to buy your own company stock at a discount. Usually this is in a taxable account. It might not be. It might also be a way that they're paying you through your 401k or something. They may be dumping stock in this, sort of like a profit sharing thing. Take advantage of these things if they're there for you. All right. Can you do your investing yourself? Absolutely. No reason why you can't. But I will tell you that most of you, even though you think you're doing it yourself, are not. Okay? Unless you're buying individual stocks and bonds, you're using a professional money manager. Mutual funds are managed accounts. You are paying someone to buy the stocks for you. Does anybody know what the average expense ratio or fee on a mutual fund is? An actively managed mutual fund. 1%. You pay 1% to them. So they take that right off the top, and then you get the balance in your account. Somebody's got to be out there managing the funds and deciding what to buy. Now, inside of your 401ks, most of your index funds, the expense ratios are down around 0.1, 0.15, something like that. Very inexpensive. Okay, but there's still a management fee involved. You're still paying something for it. Exchange-traded funds tend to be less expensive than mutual funds, especially if you're out there shopping and buying in a taxable account. I would strongly recommend looking at ETFs. They're more tax efficient, they're more transparent, and they're very inexpensive. 0.03 or 0.04. That's what they usually cost. It's almost like buying the stock directly at almost no cost. So I really like ETFs as an investment capital. What you get when you're using professional management through mutual funds, you're getting somebody who's doing professional research, they've got experience, you get greater diversification. Okay, you're not buying just one stock, right? You're buying a bunch in the fund. And that's diversification. That is a risk mitigation strategy. I'm getting watching my time. All right. So, very good idea to use professional money management through funds or through ETFs. So you don't have to make all, you can pick the sector. So for instance, right now, in my portfolios, the way I build them, I buy a lot of individual stocks and bonds, but I weight in certain sectors. And I do that using ETFs usually. So right now I have an overweight to the tech sector, which has been up, it's up over 30-some% this year. Maybe it's up 25%. I don't know, something like after this past week. I have an overweight to the industrial sector, primarily defense and aerospace. A little ETF called ITA that we invest in that has done a great job. What's in there? Lockheed Martin, all of the big airlines, Boeing, all of those companies. They're all in that defense contractors category, which has done real well this year. I'm overweight small caps. Why am I overweight small caps? I'm also overweight biotech. I've added biotech as a sector in my programs because those are small cap opportunities. I'm underweight emerging markets and international. Why? Strong dollar and the trade war stuff is going on, which really hurt the emerging markets. They were off 8%, 12% already this year, depending on where you look. Whereas small caps are up 25%. They don't have to deal with the strong dollar overseas. They're domestic in nature, and they're benefiting tremendously from the tax cuts, so their profits are up. And they're growth oriented. They tend to do real well in a growth environment. So I use ETFs as a weighting strategy. You could do something similar when you weight up, when you look at your investments in your 401k or what opportunities you have to invest, and weight in different sectors, because there's probably sector funds available to you. You certainly probably have the ability to buy the S&P 500, which Warren Buffett says is the only investment you should have. Just put your money in there. You want a big bet, over $1 million, you want to bet with some hedge fund managers that the S&P would outperform all the best hedge fund managers over a certain time period after the market crash. He won that bet. The hedge fund managers, they didn't do nearly as well as just the straight S&P 500. All right. There are a lot of mutual funds to choose from. 9,500, in fact, in the United States alone. That doesn't include the ones that are available internationally. So this is a big number, okay? So you do need to do a little research yourself on the funds when you decide to buy them, but it can be very beneficial and help you in terms of your investment to be able to do that. And like I said, there's virtually an unknown number of funds out there and categories to be in, and you need to look at the prospectus to understand who the fund managers are, what they're investing in, what their fees are like, you know, how much you're going to pay to be in this fund. Some funds are up in the 2 and 3% range in terms of cost. Now, is it justified? You have to look at their track record to see, does it make sense? Would you have been better off just being in the S&P 500? Maybe. But you can look and find a lot of information out in the prospectus when you look to buy a mutual fund. Also, they issue prospectuses for ETFs as well. ETFs tend to be passive in nature, so they're not, there's not as much active management in these. What I mean by passive is they just buy a block, usually in a sector of stocks, and that becomes the portfolio, and it doesn't really change much. You're not switching it up. A lot of mutual funds that are actively managed will change things up based on market conditions, and they're trying to beat the indexes. Okay, sometimes they do, sometimes they don't. Okay, historically, the indexes tend to do pretty good over time, and a lot of people would advise just sticking with the indexes. These are also very tax efficient, as I mentioned earlier, and less expensive. I've sort of hit this already, so I'm going to keep going. This sort of compares ETFs, index funds, and active mutual funds. These two are very similar because these are also passive in nature. So if you have an index fund choice in your 401k, it's going to be probably the least expensive choice for you, which means the most money goes to you. And if you want to think about it that way, you make the most money on that potentially. At least you're not paying a lot for the management. And usually the more difficult sectors like emerging markets, small caps, things like that are going to have higher internal costs because they're more difficult to manage. And so they have to charge more to do it. That's just the nature. By the way, the actively managed funds are the ones that are going to be in that 1% plus range, okay, or tend to be. Now, within your 401ks, you may see some of these active funds at only 0.5 or 0.65 or 0.75 in terms of the internal cost, which is pretty good. But a lot of them are going to still be up in that 1% range on the active side. Individually managed accounts. So this is what I do for a living. I basically create mutual funds for clients. That's what we do. So many of my clients are getting close to retirement or are already retired. We're talking big buckets of money, so once you've accumulated, say, $1 million or more, you've got a big enough bucket to have your own mutual fund. So that's what we do. And what that means is we can be very selective about what goes in there. If they don't want to own Altria or Philip Morris, they don't own it. You know, because they feel like I shouldn't be buying a cigarette stock. Or there's other, may have other concerns that they want to address and be, you know, very thoughtful about how they're investing, and we can control that for them and be very personalized. The other thing is a lot of people inherit stocks from parents or grandparents, okay? And they may want to keep those. I have a couple of clients that have over $1 million in Comcast, and that was something that was given to them years ago by a granddad, and they don't want to sell it. And that's fine, it's a good dividend stock, so we don't mind that one. So Usually when you're doing this, though, you're paying a fee to someone to do this for you. And I always tell people, look, if you're going to hire somebody to manage money for you, pay them a fee. Understand, if all they're doing is buying mutual funds for you, you're paying two fees. You're paying the fee in the mutual fund, and you're paying them to pick the mutual funds for you. Okay? So I argue, I don't know if you should be doing that. Find someone, if you really want to go out and do active money management, then I would recommend, going with someone that's going to build a fund for you. Otherwise, you can probably do it yourself until then, until the accounts are big enough. Or pay somebody like me an hourly rate, or take my class at the University of Richmond or Randolph-Macon. They actually have the same program through VCU also. But I don't teach that one. There's another group that does. Take that class and you'll get some insight into how to better build your portfolio out. Okay. So it's nice to have individually managed accounts if you want more control over the accounts. Also, taxable accounts, we can be very tax efficient and lower the tax rates for clients in the individual managed approach, as opposed to just being out there if you're doing it on your own, especially buying mutual funds. You can actually add about 2% to the overall return. Deferred annuities. Now, there are some advantages to annuities, one of them being guaranteed income. If that's important to you, you might want to consider an annuity. If you also would like to be able to have something that has some sort of guaranteed step up or protects you on the back end, annuities can have some attractive uses for you. Problems with annuities. Number one, how much does it cost to be in an annuity? 3 to 5%, I'll tell you that. They're way more expensive than mutual funds. Because basically you're paying the annuity, you're paying the guy a commission, and then also you have to pay for their mutual funds inside of that account. Unless, of course, you're in an index fund and then you don't earn much on it. They've got a cap on it if the market goes up. By the way, commissions on those things are significant, so they are really sold products more than anything else. The only annuities I do now are advisory-based, which means that they're in the account and they're like a 0.41 cost on those. So they've stripped out all the costs. They pay no commission on them. So that, I don't mind doing those for people that want protection. But I would argue that for most of you, you don't need an annuity right now. I'd stay away from them. I'd be careful. If you're talking to somebody who wants you to buy an annuity, they are trying to sell you something. They are commission-based. Okay? They do not have your best interests at heart. Believe me. It's not what they're about. Even if they're really nice people. And they may really believe in the annuity as the best solution for you. Okay, they're not doing what's in your best interest, honestly, because they don't know about other options, for one thing, so that's a disadvantage that they have. They're educated in one way in the investment categories, and they think that what they've got to offer is the solution to everybody's needs. They really do think that, so they can be very convincing. Okay? So don't feel bad at telling them no, although it can be hard sometimes. But stay away from most of these annuities because they are commission-based. 3 minutes less. But they may avoid probate for you. When you retire or take money out of an annuity, you've got a lot of options on how to take those payouts, which can be very attractive. You have to think this through very carefully, though, when you do this. All investments have risks. Every single one of them. Don't let anybody tell you it's a risk-free investment. Not true. They all have risk. The market risk we've sort of talked about. Business risk, where the company goes out of business that you bought, bond in or stock in. That's a risk. Interest rate risk, I just talked about that. 1% up, 8% down. That's your interest rate risk. Inflation risk, this is one people forget about. Inflation's running 2 or 3%. You're only earning 1%. You're losing money. Your buying power is going down. You have to at least beat inflation. Liquidity risk. If money's locked up over here, it can be a problem for you. You can't get to it. Owning a house is a good example of liquidity risk. Rental property is a good example of liquidity risk. Although I love rental properties in the investment category. Opportunity risk. If your money's locked up, you can't do something else with it. Okay, so these are other risks. These are some of the risks you have to be concerned with, and also currency risk. I mentioned the strong dollar. All of my international investments, we are doing hedging against currency issues. So you have to be careful of currency risk internationally.